Today's video is sponsored by Figure, the largest non-bank home equity loan lender in the US, with over $15 billion unlocked on their lending platform. They're now in the crypto-backed loan space and offering industry-low interest rates when you use your Bitcoin as collateral to get cash. Access interest rates starting at 9.9%, the lowest fixed rate in the industry at 50% LTVs. Whether you're funding a major purchase like a down payment on a home, investing in new opportunities, or even buying more Bitcoin, Figure makes it straightforward and transparent. Visit figure.com/Real Vision or click on my link below to take out a Bitcoin-backed loan with Figure today. Hi, I want to talk to you today about my friends at Bitwise and why they're the best crypto asset manager out there. I've talked on the show often about how crypto is reshaping everything from finance, portfolios, and even macro. Everything's ramping up. We've got tailwinds in DC, interest from TradFi, and growing optimism. But smart investors see all of this and focus on the how. What's the savviest way to seize this moment? And that's why so many investors I know are working with Bitwise today. They've been all in on crypto since 2017. They're OGs. They've got more than 30 products to help investors like you get access to whatever they need or want. They've got a team of more than 100 across the US and Europe, and they have over 10 billion in client assets. You know, a lot of people know Bitwise for their ETFs, how they manage the world's largest crypto index funds and the wide range of crypto ETFs they have. But not as many people realize, Bitwise manages private alpha strategies too, and has SMAs for large investors, and is one of the largest institutional Ethereum staking providers. They really do everything. These guys are true OGs in the space, and they're good friends of mine too. So please go and check out Bitwise. They're really excellent. Go to bitwiseinvestments.com and see all that they've got to offer. That's bitwiseinvestments.com, or just email them at james@bitwiseinvestments.com and let them know that Raoul sent you. Anyway, there's a million ways to access crypto. Explore how you can access it best with Bitwise. And remember, carefully consider the extreme risk associated with crypto before investing. Anyway, thanks so much.
Hey, Real Vision viewers. A quick pause to introduce you to today's sponsor, Axelar. Axelar is building the rails for the next wave of global finance. Not just crypto, but the future of how assets move, how markets connect, and how institutions plug into open systems. Think of it this way. Bitcoin brought digital gold, Ethereum brought smart contracts, but Axelar is bringing connectivity, the secure link between your favorite blockchain and traditional financial institutions, rushing to plug in. It's why top-tier firms like Dragonfly, Polychain, Coinbase Ventures, and Binance Labs are backing Axelar, and why global giants like Deutsche Bank, MasterCard, Apollo Global, and JP Morgan are already building on it. If you believe the future of finance is open, programmable, and interoperable, Axelar is the gateway. Want to digest deeper? Visit realvision.com/Axelar or follow on X at Axelar. That's AXELAR, the gateway to open finance. Today's video is sponsored by VeChain, the leading layer 1 built for real-world adoption. VeChain launched all the way back in 2015. Built for real-world utility before most people had even heard of blockchain. One of the oldest protocols and boasting 100% uptime since launch, it's known for powering real-world solutions and partnerships with global brands like the UFC. Now, they're entering a new, user-focused chapter powered by adoption in the VBetter ecosystem and an ambitious technical roadmap dubbed the VeChain Renaissance. Renaissance builds on VeChain's history of real utility and adoption to deliver a faster, more flexible core protocol, designed to meet the needs of builders and drive mass adoption. The next phase kicks off on July 1st with the launch of Stargate, VeChain's new staking program. It's an evolution that brings VeChain closer to delivering its vision of a world powered by Web3 without compromising on reliability or stability. The future is here, and it's scalable, sustainable, and evolving with purpose. Check the links in the description to find out all you need to know about VeChain Renaissance and the updated staking opportunities available through Stargate.
Hi, I'm Raoul, and welcome to my show, The Journeyman, where we journey to that nexus of understanding between macro, crypto, and the exponential age of technology. Crypto is something very dear to my heart. I've educated people over the years for as long as I can remember, as long as since I discovered it back in 2012. I've tried to help people on that journey when I realized not only it was the biggest macro trade of all time, but also the future of the financial system and the future of the internet itself. I was lucky enough to see a lot of that early. I never did as well out of it as I could have done in the early days. Like all of us, we've all got to make our mistakes on that path. But everybody's got their OG story. Who was patient zero who took you on that journey? And for me, it was two guys who were running a hedge fund in New York, who were Global Macro Investor subscribers. A guy called Emil Woods and somebody called Chad Cascarilla. Now, I have not managed to get Emil yet on, but he'll watch this, I'm sure, and he will eventually decide to come on. But Emil and Chad tapped me up back in 2012 when I was trying to figure out the world's safest bank as a way of us having ownership over our assets. I realized after the Cyprus banking crisis and the financial crisis that nobody owns anything in the financial world. Your bank account is not your money, and nothing that a bank owns is its money either. In fact, everything is rehypothecated, borrowed, lent, and everything else. And I knew that we had to do something different because the world was so in debt. And Chad and Emil reached out to me and said, your answer might be Bitcoin. And that started my journey. They actually started an exchange, which was called ItBit, one of the first exchanges in the world. Not the earliest, but pretty early. And that morphed itself into Paxos. And so I think you're going to love this conversation with a good friend of mine, Chad Cascarilla, who's the CEO and founder of Paxos, and also my patient zero, the person who introduced me to crypto. Enjoy. Join me, Raoul, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together. Chad, fantastic to see you back on Real Vision. It's been, I think, 2019 we were just figuring out since you were last here.
I know, too long. It's great to be here. Thanks for having me.
And people don't remember, but you were in the very early days of Real Vision, educating people about what Bitcoin was, what blockchain was. You did this whole series of kind of educational stuff back in 2014 for us.
Well, I have to dig out those archives. I don't want to know what I looked like then compared to now. But yes, that was a long time ago.
I know. So listen, lots to talk about. But first, I want to go through your story because your story is part of my story as well. You know, between you and Emil, you got me into Bitcoin. I know you first started talking to me about it in 2012, and I first wrote that strategy piece in 2013 because of you guys. So you're OGs to me. You were the people who passed it on to me. But I want to get your story because it's always a good story as well for people who haven't seen you for 5 years.
If you've been around Bitcoin, you've heard the term HODL, and you've heard Ledn. For over 6 years as the leader in Bitcoin-backed lending, Ledn has helped Bitcoin holders unlock liquidity without selling their BTC. With a focus on transparency, security, and trust, we've built a proven track record with tens of thousands of clients. But don't just take our word for it. Check out our reviews on Trustpilot and social media. Ready to see what your Bitcoin can do for you? Visit ledn.io/borrowing. See ledn.io/legal for terms and disclosures. Product availability varies by jurisdiction.
Like, I spent my career on Wall Street. I invested in financial services companies globally, really where technology was changing the financial industry and the way financial services was delivered. And that looked like exchanges moving to being electronic. Believe it or not, I can remember when they were just on the floor, and being able to see that electronification of trading, the way in which loan delivery could change because you could have different underwriting mechanisms, and you were buying seats and shares on exchanges all over the world when they were still basically trading at the value of the building that they were in. Now they don't even have buildings, and it was a very interesting time, and we were able to catch that really maybe kind of first wave of technology really transforming financial markets. And then we came into running our own asset manager and invested in early stage companies, still do, public companies, the whole capital structure.
That was Cedar Hill.
And that was Cedar Hill back in the day, yeah. Emil and I started that basically back in late 2004. So 20 years ago now, I know, tear in my eye. And, we kind of began to realize that there was something wrong within the financial system, and we could see that manifesting itself as what was called the subprime bubble, but really was a more generalized debt bubble.
Because that's when you guys first came to Global Macro Investor, like 2006, 7, something like that?
I think it was 2006 or 2007 we started, and, you were talking about it, and there wasn't a lot of people who were recognizing it, and, we were trying to figure out, like, how is this thing actually happening? And we eventually were able to recognize it was these funding mechanisms, and credit default swaps would allow you to be able to dig in and express the unsustainability of the debt bubble through being short the debt instruments that were trading at, very, very, very tight spreads, like 30 or 40 basis points, even on the, most lowly rated tranches of the debt. And it was obvious that that wasn't going to be able to hold. And frankly, that was a lot cheaper than trying to be short REIT stocks like New Century, where they're paying 25% dividends and you had to pay a 20% borrow rate. Crazy. And so anyways, we expressed our understanding of how it was unsustainable through CDS positions, and so we were short subprime, and we were actually short commercial real estate into the crisis, and we really saw how the entire crisis itself was part of a really what I think is was an unsustainable debt-driven bubble. And, ultimately those usually end in money printing. And so you kind of started getting to the bottom, and I will say that we certainly stayed negative too long, but we did create a distressed mortgage fund, and we were buying distressed subprime mortgages. And that's when we came across Bitcoin.
So what year was this? 2012, 2011?
This is 2010. This was April of 2010.
Who told you about it? Was it one of the kids in the office, or how the hell did you hear about it?
I was one of the kids in the office back then.
True.
Sadly, time, stops for nobody. And so actually we came across it in an Elliott Wave newsletter. And I know, it's crazy. And so, most people don't even know what that is. It's still available. It's definitely an off the beaten path newsletter, but we'd like to read far and wide. And I actually remember giving Emil one of the newsletters and saying, hey, you should take this, check it out and read this. And he came back the next day. He's like, look, I can't read any more bearish stuff. I was like, no, forget the first 9 pages. Just read the last page, page 10. And there it talked about Bitcoin. I was like, this is actually pretty cool. It could really change the financial system like Visa, MasterCard. I didn't really know what was going to happen, but our thesis really was that you could have now a distributed mechanism to move assets around, which is different than what you have even today. And I think everyone recognizes today how this doesn't work very well. But back then, it wasn't totally understood that the plumbing of the financial system exacerbated the financial crisis. It wasn't the cause of the crisis, but you didn't know where any of the assets were. So when Lehman Brothers fails, you can't resolve a failure. And so essentially we had to socialize the risk in an over-levered financial system because we didn't know where the risks were. And I thought that the blockchain would enable us to have a much safer and more efficient financial system.
And who were you talking to back then about this stuff? Or was it just you and Emil just trying to figure this stuff out?
Yeah, it's an echo chamber. There wasn't a lot of people because, we had a pretty non-canonical view of the economy.
You were quite out of consensus those days.
It's uncomfortable being out of consensus, but it's the only place where big ideas come from. Because if it's a big idea and it's consensus, it's already big. Right? So you have to be ahead of the curve.
Amazing. So then you started investing in the space broader. What were you investing in? What were you looking at? And then talk about starting ItBit, because that's really when I started speaking to you guys about this.
We, being so early in the space, really had an opportunity to catch a lot of the first generation entrepreneurs. And like an example would be we invested in BitGo in the seed round or something like that. And there's a whole number of other companies that we've invested in. And we have a venture capital arm, there's still one that exists that Emil runs. I don't run it, called Liberty City Ventures. And that's something that I helped found as part of Cedar Hill Capital, the general asset manager, and he's still running and investing to this day.
I've been trying to get him on bloody Real Vision, but he won't do it. He will. I will get him eventually.
He'll get there. You gotta just be persistent. He's a little bit more private, but I suspect that he'll be willing to come on sometime soon. And anyways, the whole point of Liberty City Ventures was to invest in blockchain infrastructure companies and crypto infrastructure companies. And you start thinking about, well, what could it be? Is it wallets? Is it exchanges? It's all of these things. Is it AML, KYC? Is it tokenization mechanisms? The way those products are delivered are wildly different than in 2010 or 2012 or 2014. But it's still the same case that it's that infrastructure that you need in order to really create mass adoption. And one of the companies that we created and incubated was ItBit, which is now Paxos. And we incubated a lot of other companies. It's just that I recognize the potential for ItBit and Paxos to maybe be something that could really transform the world. And so rather than continue to invest, I decided to come in and run Paxos. And that was in basically late 2014, early 2015.
Because ItBit was when I went to try and start the world's safest bank and gave up. And then you guys said, hey, look at Bitcoin. I bought it on ItBit. Because you guys had started an exchange. I'm like, how the fuck do I buy this? And you said, well, I've started an exchange, both in Singapore and New York, I think it was at the time. And so that was the start of my journey from that. And then you built Paxos out of ItBit, which wasn't obvious at the time because it was like you weren't getting massive volumes at ItBit. You were kind of one of the exchanges, but you had plans to build something really institutional. You always said that to me is like, we don't want to build just a regular exchange. We want to do something really important. So what was the vision behind Paxos?
Well, and by the way, that's certainly been a winding path. Maybe in hindsight, we should have done something that was more retail oriented. But the idea was we started actually, ItBit, and one of the co-founders of Tails worked for me for a long time. He's a Singaporean out of Singapore. And the reason we did that is because it was unclear how you could operate in the United States. And we actually figured out a way to operate. It took us about 2 or 3 years. We created a trust in the state of New York, the first trust in the whole United States to operate in crypto and blockchain. And we predated the BIT license, which New York is very famous for. So we even predated that mechanism. And that's when we were able to come into the U.S., and that's when I came in as the CEO. And really, while we started as an exchange, the whole concept of getting a trust was because we wanted to be infrastructure that people could build off of. It's been the same all the way back since we started ItBit, was how can you enable blockchain infrastructure to change the financial system? How can you take and re-platform the world's financial system? You have now nearly $900 trillion of assets. How can you get those to move in real time, in a programmable way, in a way that will fit with where the economy is going to be in the next 3 to 5 years? You can't do it on COBOL mainframes, which is still largely how those assets sit. Most people don't even know what that is. But they still exist, and that's actually where the vast majority of assets in the world are moving and sitting on, and that's part of the problem. And that's what we wanted to solve was how can you remove systemic risk? How can you create a more open financial system? How can you create a real-time internet-based financial system? And doing that would be very valuable business. And I still think that's the case. And so that's the reason we started the company.
Every time I've caught up with you over that kind of, you have to wander in the desert when you've got no regulatory clarity, you've been pretty clear. It's like, look, this is not easy, but we're just going to build the best institutional quality suite of services and products that we can, and eventually the market will catch up with us, which is pretty much what you did with Bitcoin to start with. You've always been kind of living in the future, and here you are, and we've kind of had the Cambrian explosion that you've actually been waiting for all of this time and preparing for. So what are the kinds of things that you're focused on now? What is the big opportunity that's in your present? We'll talk about the future in a bit.
Yeah, I think one of the things about Paxos is that we have been able to bring large institutions into the crypto space. Examples are PayPal and Mercado Libre or Venmo or Interactive Brokers or Nubank. All these firms initially launched or to this day continue to use Paxos as their infrastructure to be able to enable either crypto access for their customers.
In what way do they use the infrastructure? What are you doing for them?
Yeah, it's probably worthwhile to maybe just step back and describe what does Paxos do at this point. And so we really have two aspects to the business. One is around our infrastructure, and then the other is around tokenization. And on the infrastructure side, we are providing custody wallets so that firms could launch, buy crypto, sell crypto, send and receive crypto, hold crypto to their customers. You went on your PayPal app and you were buying or selling crypto, it's Paxos in the background, or Venmo, or whatever it might be, Interactive Brokers. And we also provide stablecoin infrastructure, like for Stripe and MasterCard and others, where a merchant needs to accept a stablecoin. And we're the wallet infrastructure that accepts the stablecoin and can turn it into cash for that merchant. Or there's examples where we might have somebody's cash account, access to the cash account, and can then send out a stablecoin. So you can then send and receive stablecoins using our infrastructure. And then that's the infrastructure side of the business, the solutions that we're providing. And then on the other side, we're doing tokenization. And believe it or not, we tokenized U.S. equities all the way back 5 years ago. We had a no action letter from the SEC that allowed us to do it. And it was for Bank of America and Credit Suisse and SocGen and Instinet. And of course, then Gary Gensler came in and our no action letter expired. And, we had an agreement that he would allow us to, be able to launch this more broadly. And, he just really, kind of backtracked on everything. And in fact, became worse than even backtracking. Became, kind of, yes, hostile and punitive and, really operating illegally, in my opinion. And that was a shame for the U.S., not just for Paxos. But on the tokenization side, not just equities, we have the largest gold token. It's approaching $1 billion of tokenized gold. We've had it for, 6 years now. And we, of course, tokenize dollars through stablecoins. And that's what most people know us for. And we generally don't do our own stablecoins. We do it for other people. So PayPal stablecoin, it's a white label stablecoin. It has our name on it. We provide all the underlying infrastructure. It's kind of an out-of-the-box service. We also have done it for a group of companies. And it's called USDG, the global dollar. And that's Robinhood and Kraken and Anchorage. MasterCard just joined yesterday. Fiserv also talked about how they're going to be using this. There's a number of very crypto native companies that use it too. It's probably 25 or 30 firms that are using it. It's a kind of a consortium dollar where everyone shares in the economics. It's an open system. And we're just the issuer. And we also issue actually a yield-bearing stablecoin, which we do out of Abu Dhabi. We're regulated today in New York with a trust and the equivalent of that in Singapore and Abu Dhabi. And so that's what our business does today. And so we've been doing this and building it and working with a lot of great companies that I all mentioned here. And it's not just all large institutions that use us. We have smaller companies too. And, we're trying to make sure that we're making this available for everybody. I just think that you need kind of neutral infrastructure in order to make this become widely utilized. And that's pretty common in the financial industry. If you kind of look at where neutral infrastructure sits, it's been exchanges, it's been clearing corps, it's been payment networks that everyone can come and use, because even a company with the largest market share like JP Morgan on a global basis still has a very small, less than 1% market share of, financial services. And so it's a very fragmented industry. Everybody already has the end user. Everyone needs shared infrastructure.
That's the argument against people like Coinbase scaling it on. Everyone's got to scale it, of course, but because it needs to be a neutral counterparty, I guess, or a neutral infrastructure layer, that it can't just be built on Circle, it can't just be built on Coinbase. That
is the whole point. I mean, ultimately, if you're using Coinbase for your infrastructure, they may or may not be competing with you if you're a broker or you're a retail app or whatever it is. And there's always competition in the financial industry because there's so much overlap. But very frequently people want to have neutral infrastructure so that they're not finding themselves in a position where they're funding a competitor. And that's generally what would happen if you weren't using neutral infrastructure. And so that's the importance of it. That's why we've taken this tact. Of course, because of the way the industry evolved over time, you could get to scale faster, ironically, by simply trying to go acquire the end user rather than having a neutral infrastructure perspective. I don't think that's always going to be the case because we're now hitting a moment of mass adoption and different regulatory clarity. But that's why I think you've seen certain companies get to really big scale. And they've been focused on acquiring users. And it's actually made it very interesting in how the competitive dynamic is going to unfold because, there are so many big companies that have end users, but they didn't grow up in a native Web3 DeFi world. And the ones that may have learned lessons that other companies aren't able to learn. And maybe they will actually, ironically, be able to succeed the best because competition was being prevented from entering. And so, there's a lot of twists and turns, and you never know exactly what kind of boomerang effect you get. It will certainly be the ultimate irony for, kind of the choke point 2.0 if the companies that were choke pointed actually end up being the winners because they learned lessons that no one else could learn.
Are you starting to see corporates using stablecoins? I've just, because for me, there's many of these multinationals that have all sorts of payment flows everywhere. They pay enormous amounts of banking fees. There's a lot of restrictions. So if you're a metals and minings company, you're in Angola and you're in Tanzania and whatever, and you need to move money around. Are you starting to see the rise of corporates yet?
Definitely. There's many examples of this. There's a couple of different elements around stablecoins. When we talk about stablecoins, everyone just says dollars. And I think that's rightfully so because it's the vast majority. I think we have the largest stablecoin outside of dollars, and it's a gold stablecoin, and it's, it's still less than $1 billion, right? So it's mainly dollars. And so why do you need a dollar stablecoin? Well, because everybody wants a dollar, and it's really hard to get dollar bank accounts, especially if you're outside the U.S. Even in the U.S., by the Federal Reserve's own studies, 20 or 25% of the American population is unbanked or underbanked. So why do you need a stablecoin? Because you don't have a bank account. Why do you need a stablecoin? Because you're outside the U.S. and you don't have access to a dollar bank account. Why do you need it? Because you need to be able to move money in real time. Maybe you're a trading company. Maybe you're doing remittances. You're a person in the U.S. and you want to send money to Mexico. You need to move not in 3 days and high fees. You want something that's immediate. The other reason could be because you want something that's programmable. You're getting to this agentic economy that everyone's talking about and you write about so much. How could you have an agentic economy without having a stablecoin? Having something that's programmable. Mark Andreessen has said software is going to eat the world. And if that's true, and I think it is, software is going to eat money too. And what does software eating money look like? It's a stablecoin. It's not the way the current money system works. So there's so many examples of where people would need to use a stablecoin versus the current rails. No dollar access, slow dollar access, no bank account access, programmable usages. And so some big examples of that are people paying suppliers in other countries in dollars. And now they can sit there and hold dollars and not turn it into some local fiat where you have a currency that is unstable and depreciating, which most do against the dollar over time. Even though, we're always worried about the U.S. debt load, which is unsustainable, of course. It's still not as bad as most other countries that you could be living in. And so all of those things have pushed the need for either corporates or for consumers to use dollars. And the TAM is huge here. You're maybe at 22 trillion of M2 today, of dollars. There's 100 trillion of global M2. It's probably growing, what do you think, 8 or 10% a year? I mean, you write about this all the time. In 5 years, you're talking about like $150 trillion of M2 in the world and, 30 plus. I mean, you're not going to have $250 billion of stable coins. You're going to have, trillions, maybe tens of trillions of dollars of stable coins, which is, a huge shift that's going to happen in the world.
And even Scott Besson understands, another old long-term GMI person, he understands that you finance the deficit by the stable coins because you're basically moving out the Eurodollar market to end users all around the world.
See, that's exactly what it is. And I don't often get into like the intricacies of the plumbing around Eurodollars and stuff, but because not everyone understands, so it's always so fun to talk about it. I think that's exactly what's happening. So central banks are selling dollars today. They're selling dollars. They're actually buying gold. They're doing other things. But you know who wants dollars? All the individuals in the world. They want dollars. And you can't get it. But with a smartphone, you have 85% of the world penetrated on a smartphone. Maybe, I'm going to guess, less than 5% of the world has access to a good dollar bank account. And by the way, only 60 or 65% of the people even have access to good bank accounts in general, in other currencies. So you have this huge need to go from 5% dollar penetration to 85 or 90% penetration through a smartphone. You can go directly to the end user. Dollars are a product everybody wants. It's just being delivered in a way that nobody can use or get access to. I mean, just think about that for a second, right? I mean, everybody wants this. You can't get it. And, stablecoins is the solution.
people don't realize most of the dollars supplied to the world actually come through the Japanese banking system, a bit of the Korean banks, and it used to be the European banks until they completely destroyed themselves. All the dollars come through those systems because they get direct access to dollars. And so it's really hard then if you're a Filipino to get it because you don't have direct access, and your local banks don't either very easily. They have to go through the Japanese banking system to get it.
Exactly. I mean, the layers of banks, maybe people understand this. Well, why can't I get $1? You're in the Philippines or something. The reason is that bank, and they probably have some small bank, or maybe it's a big one, then needs to go to another bank, probably in the region. And then they might go to a U.S. bank, and that U.S. bank might be moving the money, and that might be like a really big one, might be moving money from one of the smaller U.S. banks. And so you could have, maybe it's only 2 hops, but it could be 5 or 6 hops. Many days, many fees, lost interest, as opposed to instantaneous. I mean, a stablecoin is moving 24/7, which is important, not just 9 to 5, but it's also moving instantaneously, virtually for free, and it's programmable. This is a big shift because really there's nothing special about financial information. It's regulated and very valuable, but it's just information. It can be turned into code. Just like your email, it gets turned into code, just like this video call is turned into code. There is no specific reason why it needs to move slow. It's not like a physical bar of gold or some cows or whatever, a piece of land. That's physical. Actually, money and financial information is not. So the idea that it's moving less efficiently than how you get mail, physical mail, or how Amazon can deliver you toilet paper to your house is bananas. It doesn't make any sense, right? I mean, why can you get toilet paper in 2 hours, but it takes you 4 days to move $1 that isn't anything except for electronic?
Here's another big one. A long-term GMI guy hit me up and said he was running treasury trading and everything else at National Australia Bank, Drew Bradford. And he's like, well, we've been developing stablecoins infrastructure because the US is going to T+1 settlement for equities and everything else. But if you're in Australia, you basically got another, it's T+3 settlement for FX. And they have to go through the Japanese banks to actually make the payments. It's like we've got hundreds of billions of dollars of the Australian economy tied up because of a settlement. So we just use stable coins and we can settle instantaneously. It all goes away.
By the way, that's exactly right. The FX settlement is basically T2 or T3. You're now settling equities in T1. There's this huge capital drag as a result of that. Lots of Asian players have exactly brought this up and basically said, well, we need to use a stablecoin so we can, stop trapping all this capital. And it's not just capital trapped in like equities trading or FX trading. It's trapped throughout the whole economy. All over the place. Everything that you want to do, T1 or T2 settlements, by our own estimates, it's probably trillions.
And everyone's taking that interest from you. You don't realize it, but everyone's taking a scoop of the interest from trapping your capital.
That's right. And if you basically said, and I think the accurate number is somewhere between $500 billion and $1 trillion is trapped, that's a lot of money each year. That's 50 billion to, more money that is lost to different firms, and of course getting put into maybe a frictional middleman. And I think you're going to definitely have changes that will happen to the capital markets that tends to take a little bit longer because, you really solve these problems at the edges where that's where disruption happens. Here's the way the current system isn't working anymore. And we kind of went through a bunch of those ways, and the system's not working. You start to build up expertise to solve the problems to get to scale, and then you can go in and solve some of the really big, more mass market problems because you built up the expertise and the capacity to solve them.
How are you thinking about fungibility of stablecoins? Because they're being built across a number of different chains. How does that world figure itself out? Because you can't have to check, what kind of wallet do you need to take a payment from somebody because they're doing it on Solana and you're only settling on ETH or whatever it is. How are you thinking about that? We're
still very early days in stablecoins, precisely by what you described, because we're even sitting here talking about chains in some ways. You know what I mean? Like, it's like sitting here, it's not a perfect analogy, but it's like talking about what database. Like, do we have any idea what database all this information is moving through between you and me right now? No. And why would we? It's completely superfluous. Now, somebody knows the answer to that. We just don't know. Just like no one knows how their smartphone works. Somebody does, but you don't need to know. What you're trying to figure out is what problem can you solve? And it should be, I want to move instantaneous payments. And you shouldn't have to think about these other aspects. And partly the legislation that's passed in the U.S. goes some way to making that possible because it's setting consistent reserve requirements and regulatory requirements. That's not going to make everything perfectly fungible, but it comes pretty close. The whole idea is that a stablecoin should be essentially the safest bank in the world that you're trying to create. It's basically, in many ways, a narrow bank, but it's not even a bank. You send money to Paxos, we buy T-bills, it's held in a segregated account. If Paxos fails, you still have it. So when you have a Paxos stablecoin, and by the way, this is different from Circle and Tether, when you hold a Paxos stablecoin, you have an asset. Which is the U.S. government debt, which I guess is a liability. But nonetheless, you own the asset. You don't have a claim against Paxos. You're not loaning money to Paxos. When you own USDC or own Tether, you're loaning money to those companies. They are only licensed or not even regulated in many places. And so you're giving them a $0 loan, zero interest rate loan. And that means you have a commercial liability. It's a debt instrument that you're holding when you hold USDC. It's not an asset.
People don't realize that.
Nobody realizes that. And I mean, to be honest with you, it's been a little bit frustrating because that was the whole reason why we went and got the trust. Because when we hold your assets, we're putting them outside of Paxos' name. If Paxos goes bankrupt, you still get your assets. That allows it to be treated as a cash and cash equivalent. And by the way, this is exactly what the legislation does. That's why I think is great about the legislation is it's codifying the rules under which we already operate as a New York trust or in Singapore, regulated by the MAS, or even in Abu Dhabi by the FSRA. They require it to be done this way. But believe it or not, neither Tether nor Circle are actually regulated. They have licenses, and so you don't have these types of protections. And the legislation enables that. It still won't create perfect fungibility, but it should come pretty close. And what you have is T-bills and overnight repo over-collateralized by treasuries backing a stablecoin. And when you do that, you basically are making it as safe as you possibly can. Maybe the maturity is like 2 to 3 weeks or something. Basically nothing on the whole thing. You have half of it overnight and then half of it like spaced out over a month. And that's the most liquid thing. That's the safest dollar in the entire world. It's far safer than dollars in a bank because you're just holding T-bills in somebody's name. And I think that's the really interesting thing is you can now make the payment system.
Which was that idea when I tried to start that world's safest bank. It was to have a non-fractional reserve bank that just held T-bills. And this is an electronic version of that.
That's basically all a stablecoin is if you build it correctly. Now you can start to add other assets in. Well, I'll just put a little bit of gold or a little bit of Bitcoin. And by the way, that's fine, but it's not a dollar stablecoin, which is how Tether is set up. Or, hey, I'm going to, put a bunch in banks and I'll be over the FDIC limit by a lot. And like if it fails, I have a problem like Circle did with Silicon Valley Bank. So those are the problems that can be manifested if you're not operating this correctly. But when you do operate it correctly, it can be treated as cash and cash equivalents under accounting, moved very easily, and you've now segregated the payment system from the banking system. And you take the payment system and it's not tied to fractional reserves. You can actually have a far safer financial system now when you have a fully reserved instrument that people are moving around that you then build the leverage on. And that doesn't exist today because of a lot of legacy reasons or good reasons, but they've created this too big to fail system that is not just for too big to fail, it's even too small to fail at this point. And like nobody can fail. Right? You couldn't even allow Silicon Valley Bank or anyone else to fail. No one can fail. And like this, by the way, there is no such thing as a failure in a bank. Like the regulators come in and they divide up the assets and move stuff around. I mean, there's no such thing as a bankruptcy for a bank. But you should have an ability for like the shareholders and even the debt holders, to have a loss. But you can't when the whole payment system is completely tied together. It's like a ball of thread. You can't unwind it. This is a way to unwind the Gordian knot of the financial system through stablecoins. And I think it could be a hugely powerful thing for the US dollar because we have a lot of debt to issue. Everyone wants dollars. I don't know if it's a good thing that you can create enormous demand for US dollar debt because it allows you to be more unsustainable. But on the other hand, it really does probably reinforce the ability of the U.S. to dollarize the world, which is ultimately good for our values and for the economic system that we're promoting.
Yeah, and on the flip side, we all own Bitcoin, and that goes up when they keep debasing the currency anyway. So there's the kind of whole game is to be played here, and it's all set up, the infrastructure for that. I've always thought it was a transition to a new system, and as part of that transition, you're debasing the old system, but you've got the life raft, which was Bitcoin, and now you've got the way of changing the system to the better to get rid of the flaws. Here's a question for you that's interesting to me, and I want to get your thoughts on it. Circle is trading at an enormous valuation suddenly. And to me, it's either because everybody's an idiot, or we're missing the fact that there are network effects at play here. And that and I'm just thinking for you as well, is like, you're talking about the infrastructure to build on, but it's what builds on the network that creates the actual value of the network in the end. Is that what you think is going on here, that people are extrapolating out?
I think there's definitely elements of that. I mean, it's very interesting to see at one point, it had I think a bigger market cap than Coinbase.
It's got a bigger market cap than its stablecoins.
Yes. I mean, it's like, so you're certainly discounting an enormous amount of growth and network effects and the ability to monetize those network effects. I mean, that's what the market has to be doing. It's always hard to comment on exactly a competitor where the market is.
For you, in your shoes, you either think, okay, it's a bad signal and people are just getting delusional, or, okay, if the market's telling us there's potential a lot of network effects, then what does that mean for Paxos?
By the way, I think it's probably both. You know what I mean? Just like anything. The markets get over exuberant and you have technical effects because there's so much of the supply is locked up and, you can't even get to borrow and other things. So it doesn't take a lot for it to become almost get a meme stock effect for periods of time. So there's probably some elements of that, but obviously it's also telling us something about network effects, in my opinion. And I think that's also, in some ways, showing how valuable a network is and why you want to actually have it set up in a way where you have infrastructure enabling the network where the economics are shared amongst everybody, because it's going to be so valuable. You want to be able to participate in it. And so you want there to be something that is neutral. And I think that's what, we consistently hear from people. That's why MasterCard joined, and that's why Fiserv or WorldPay has joined, and Robinhood, lots of big companies that use stablecoins or are in payments. They're trying to think about, well, how do we make sure that we set up the right foundation if this is really going to be as transformative as everyone is talking about and as they think. And I certainly think that if you don't set it up the right way, then it would be a really unusual situation to have one or two firms take all of this opportunity from very large incumbents that could very easily sit here and adopt something that would change that.
And also, to your point, the reason, one of the reasons that I got into all of this in the beginning was because of the Cyprus Bank bail-in, when you realized that the dollar was not your dollar, right? It was lending money to the bank, which is what is happening with Circle and Tether. And people aren't realizing they're repeating the same thing. And this is a really important point that doesn't matter until it really fucking matters.
And by the way, it almost did. When Silicon Valley Bank failed, they were the single largest creditor, $3.3 billion to Silicon Valley Bank. And, essentially, if the government had bailed out Silicon Valley Bank, which was bailing out Circle, they would have failed. And, that's a kind of an amazing thing. But the network effects are so strong and there were so few alternatives that, it's been able to push through that effect. But that's why the legislation is important, because it's getting rid of this regulatory arbitrage that they're both existing in to this day, which is that they're basically issuing zero cost debt. And no one fully realizes that that's actually the implication when you hold it, that you've made a loan to it. But if you went on Coinbase's books and you look at their 10Q, guess what? It shows a loan to Circle. It doesn't show USDC. It's a loan to Circle. That's what USDC is. By the way, that's the same thing with Tether. And it doesn't mean that they're not fully backed. It doesn't even mean that they're going to fail. It just means that, your relationship with them is different than it appears. And the whole point is legislation and the way we're running things are going to shift that dynamic. What's so interesting about a dollar stablecoin is ultimately it's a wrapper. And the dollar is a wrapper, theoretically, for T-bills. You could make it a wrapper for a lot of other things like Maiden Lane and a sieve and corporate debt, which the Federal Reserve has periodically put onto its balance sheet. But it basically should just be T-bills. It's actually really simple. By the way, it used to be a wrapper for gold. and it was a wrapper at $19, then 23 or 24, and then 30, whatever it is, and they got up to $43 or something, you can always go back to the dollar being a wrapper for something else. So like going back to like your end game point, like how does this end? Like you could very well end where the dollar is now a wrapper for Bitcoin and gold and T-bills, or just one of them, whatever it might be, or maybe not, right? And, something else altogether happens. But dollar's just a wrapper.
That, I think, is where the network effects, and it's the second side of your business, which is tokenization, right? These networks can be used for tokenization of anything. So, i.e., anything can be wrapped and moved around the system. And I think this is still not fully appreciated yet. Yes, Figure are trying to do some stuff. People are doing stuff, but people have no idea the size of these markets, which is the equity market. The DTCC do, I don't know, $4 quadrillion of settlements.
Yeah, they hold $130 trillion or something of assets. It's crazy. 130. They literally hold like 15% of all the world's assets sit in something no one even knows. It's amazing. They do a good job at doing that, holding it. Well, think about this for a second. If a dollar is just a wrapper, what happens when you tokenize the thing that it's wrapping? So why couldn't the U.S. Treasury just tokenize U.S. debt and issue it on chain? And then what is the dollar? It's a smart contract that anyone could just drop treasuries into. And, so I think there's like second and third order effects that maybe the equity markets need to also be thinking about, because once you start tokenizing the underlying reserve asset, which should happen, like there's no reason why the Treasury needs to have, some intermediary do it. They could just have it happen themselves. And once you do that, anybody who's holding treasuries goes to a smart contract, they're tokenized, you put it in the smart contract, and out comes a stablecoin. Right? And so you start to think along those lines, it's not just about even one issuer anymore. It'll be about many issuers. And it'll be about what should you pay for that? Nothing, zero.
So that's the question, what should you pay for this? How long is this arbitrage of, people like Tether's the world's most valuable company? No, it's borrowing money at zero interest and receiving interest. It's just an interest rate arb in gigantic size. So it's free money.
Yes.
But that's got to get competed away very soon, right? Because you guys have, and several others have got kind of interest-bearing stablecoins, but you've not been allowed to use them in the US.
Yes, or, you set up something like the Global Dollar Network where you can pay out the interest, at least to the intermediaries. I personally think a interest-bearing stablecoin is exactly where you want to get to, because you shouldn't just be democratizing access to dollars, which is what a stablecoin is doing. You should be democratizing access to the risk-free rate. In what world should the wholesale rate be 4.25% and the retail rate is 0 to 2%? There's no way that should be completely compressed. In every other industry, the internet has completely compressed the spread. And if you actually think about lending money to a bank, especially once you're over a $250,000 FDIC limit, you are taking on credit risk. You should be getting paid more than the risk-free rate unless you're getting services that you value and are willing to take less. But you should be able to make sure that everyone gets the risk-free rate as the base rate, not just very sophisticated people. I actually think it's profoundly undemocratic and completely a poor social and economic policy for us not to make it easily and readily available, which you can do with the new technology. It didn't exist before. That's why it was that way. Now it should be available. But the current stablecoin bill doesn't make that possible. Maybe the market structure bill will. And I think when you get to that point, in the case of, Circle or anybody else, Tether, they're doing a great job of going out to people who don't have any access to dollars. You're in the Maslow hierarchy of needs, of the monetary Maslow hierarchy of needs. You're I just want dollars. I don't care about anything else. Getting dollars to me is better than nothing. You get dollars. And, you might not be getting interest back from the issuer, but that's okay. You have the dollar, and maybe you can go into the DeFi ecosystem or the centralized exchanges, and they'll give you a yield on it anyways. And so, you're kind of able to mask, at least for some time, that the issuer is keeping a big chunk of interest. But I wonder how long that will last for. And in certain cases, you see there are really big deals that are being done with individual distributors of stablecoins because there is pricing pressure that's creeping in. I think like the V2 or V3 model of stablecoins should be all the interest is going back to the end user. Right? I mean, and maybe if you have a retail user in like, I don't know, Chile or something, and they can't get dollars and, they're fine with no interest, you always have something that you're collecting. But it should, I think, pretty quickly become a Dutch auction to the risk-free rate.
The other thing that I've talked about for a long time, in fact, when I first ever wrote about, first wrote about blockchain, it was the idea that like OTC options, that whole market, because that's just a smart contract with collateral attached. And it's a big, a ton of it had to go to the exchanges in the end because it's such a big fucking mess. I just don't see why all of that doesn't get tokenized, because we've essentially doing it with perps and instant settlement and everything on DeFi exchanges. And again, that's another quadrillion-dollar market.
I think that's exactly right. I mean, when you talk about these like kind of complex structured derivatives and structured products, they're just smart contracts. It's just that they're not on chain. So you need some centralized intermediary to say like, here's what's going on, because you have one person and you have another person, and what's the source of truth? Well, by the way, that's the whole point of the blockchain. Now, it hasn't gotten to the point where it could provide enough utility compared to an exchange, because everyone's already plugged into it, and there's a lot of capital tied up there and other things. But as you solve other problems on chain and you build up scale, it's inevitable that everything will migrate on chain. It's just a timing sense.
I just feel like we just break apart all of these parts, and at the issue is at the center of the financial system, nobody knows who owns what, and there's a ton of capital tied up. And as you start peeling back all of the layers, you start freeing up capital, and ownership becomes a real thing as opposed to a false thing.
That's right. Yeah, because you just have all these layers of intermediaries, and in order to make things move, you had to create joint ownership. Just like everything at the DTC is held in this company called CD&Co, which most people definitely don't know DTCC, and they probably don't know CD&Co. But basically, everything is held in like what is called street name, and so like you can't have anybody fail because you have mutualized ownership of everything. You don't own any of the underlying stock in your account. You have to pull it into your account, and it's very complex.
Do you remember when I went down this rabbit hole and I found out that, just speaking to the New York Fed and the DTCC and Euroclear and the ECB, that at the center of the clearing system, there is no client segregation.
That's right.
If anything goes wrong, the Fed lends them money and takes collateral, which is anything, and you don't own anything. Nobody owns anything. As you said, it's all mutualized.
I think we got to like the logical conclusion of scale. And like everything, all of history is essentially about bundling and unbundling empires and, technologies. You kind of bundle because you're getting returns to scale, and then you get so big and it becomes like so fragile, and something disruptive comes along that you then have to unbundle everything, and then you rebundle again. And I think that's why everyone is like pushing decentralization in so many aspects of society, because we hit the end of centralization, creating returns to scale, and now it's creating like actually negative returns to scale, most likely. And you need to break things apart. You have new technology that comes along. That's disruptive, and nobody necessarily likes it, but we're getting used to more and more disruption. But it still has never come for the financial system. It came for a lot of other industries, for telecom and media, whatever. It's coming for the financial system. It was held back by regulation, but even kind of the most aggressive and difficult environment of the Biden administration still didn't stop this from moving forward, because it has so much truth to it. You know what I mean? Like that is a sign of like how strong the truth is, that even trying to fight it was still fighting the tides of time and the tides of change. And so decentralization is going to be such an enormous unbundler of value, whether it's capital that we've talked about, ways in which people are going to be able to get access to products, some really big changes.
Are you seeing, when you're speaking to clients and new clients, them thinking about what chain their stablecoin exists on?
Definitely.
And is it, my working hypothesis, and you'll know better than I will, is that EVM seems to be the most obvious because it's got the largest, broadest ecosystem. And I've been saying this, people like Ethereum's dead. I'm like, I don't think so. I think the financial system, no bank I've ever been into ever has had an Apple computer. The whole fucking lot is Microsoft operating systems. You know, it's like they just agree on one thing and they do it.
Yeah. Well, it's such an interesting way of approaching it. On the one hand, like no one should really care about like the underlying chain because it's just like what can you do and what speed can you do it in and what's the cost, and what is the privacy and what is the anonymity. And so I actually think we're very far away from like being at the final word of chains. Of course, there are network effects, so this could not shift.
Yeah, and we won't even know what chain is. Like I don't know what Wi-Fi you're on. I don't know anything. What computer you're on. It makes no difference. We should never know.
Exactly. And so there's a couple of things to unpack with what you just said that I think are interesting. One is part of the reason why you've been able to get such adoption is because it's always been pseudo-anonymous, which means that like, you know, my identity and your identity is masked, but you can see exactly what's moving and you can more or less trace it back, you know, because there's some place that you had to get onto the world and like, you know, these companies do graph analysis and you can pretty much figure everything out. But could you put a whole economy on a chain where you don't have privacy of the transactions? Like say you're JP Morgan, I'm Goldman Sachs, like you can't have the value of our movements constantly be shown, even if you're, you know, grossing and netting everything up, and then do that like HP to like some supplier and this thing and that. You can't, this is a very difficult thing to imagine. So somehow you're going to have to begin to add privacy in, which ironically not having privacy is what made this reach an adoption curve. And now the next question will be, how do you enable privacy? I think that's one thing. The second thing is that ultimately these chains are programmable databases. You want that to be as cheap as possible. Right? You know what I mean? Like you want your AWS to be as cheap as possible. You don't want the token to go up. You want it to not go up because if that's what you're paying for access to the network in, you need it to be cheap. Right? And so when we talk to companies, they're always concerned about like, well, especially in payments, how to make this as cheap as possible. So you want to go cheap, you want to go one direction. On the other hand, some people say, I want to have this be as secure as possible. I want to have this be as decentralized as possible. And that's where you see people go towards Ethereum. And, you know, of course, then there's Bitcoin, which is a whole different animal because that's really an asset as opposed to a chain.
To go back to your point, it's a really interesting point, right? If the token price is essentially the value of the slot on the blockchain. Now, the more popular it is, even if it's cheap, it still means it goes up in cost.
That's right. That's the perverse effect here is like you're just a layer on top of AWS. You want to pay as little as possible for basically the program you're running on top of AWS because every chain is running on the cloud. So, you know, if you want your chain to actually be cheap, you don't want it to be expensive, but of course you want it to be widely utilized and you want people to hold the token and have an incentive for like using the network. So you have a very tricky balancing act. And so it's not just about price with like an L1 or an L2 or even L3s or whatever it is.
Because if the token's valuable, you get more security and people build more facilities and services on top of it. So the network's more valuable to you as well. So yeah, it's really interesting. I hadn't thought of it that way.
You know, but then you're like, I don't want to pay $30 every time I do a transaction on a chain. You know, that doesn't work, or $20 or something. You know, you can't have the surge effect. So, you know, there's a lot of balance, and that's why I still think it's pretty wide open for L1, L2 development. But clearly, whether it's Ethereum or obviously Solana has done an unbelievable job too of like becoming the other chain that everyone talks about. Lots of things being built on Bitcoin, but we're still so early. And those early network effects might be valuable, but you never know if that's the Friendster MySpace to the Facebook that's coming. But maybe not. You know what I mean? Like you just can't quite tell because we've gotten to a lot of scale on one hand, but again, $900 trillion of assets. And you got like $3 trillion of crypto and you got like $250 billion of like dollars of real world assets. Pretty tiny. And so, you know, it's absolutely possible that everything we're thinking could completely invert.
I think hopefully this conversation will get people thinking how actual large the use of blockchain will be over time and in a multi-chain world. And this is the one thing I keep saying is like, it's a $3 trillion asset class today, the blockchain, the tokens. And it's going to 100 trillion in shorter time than anybody imagines, just because they're going to use, there's 900 trillion of assets, plus all the derivatives and everything else. There's quadrillions of stuff that will end up on chain that will accrue value to these chains. So of course they're going to be worth 100 trillion plus.
Well, $900 trillion is just the assets. That's not the derivatives and everything else, like you were saying. And, I also think what we didn't touch on is that crypto isn't just about like a store of value or like a chain mechanism. It's also a whole different way of being able to create network effects and actually change the way in which people work together and live together and operate together as communities.
It's a coordination layer.
Yeah, so it's a whole coordination layer. And so, I don't know, I was talking to one, a DeFi protocol in Solana, and they were telling me, guess how many assets they add a day? Just pick a number.
20, 10.
33,000.
What?
They didn't even know how many they had listed on there, because you just go to like pump.fun and then you put it on this DeFi swapper. And anyways, my point is that like there's 3 or 4 or 5 million types of tokens on just Solana as an example. A lot of those aren't going to end up being worth something, but you're going to find like innumerable ways to use things and shift things around and change the way in which like people are interacting, just like we're doing now. Like our lives are radically different than what someone looked like 40 years ago, in our lifetimes, right? I mean, it's crazy how much different it is. What is it going to look like if you start to fast forward 10 or 20 years where things are multiplying even faster?
Another thing people don't appreciate is I love crypto because they come up with the first crazy use case, turn it into wild, rampant, ridiculous speculation, go bust, and out of the phoenix rises the ashes, right? The whole NFT thing was proving that valuable assets should and can be on chain, and we're seeing that with the art market surviving. Pump.fun to me is super interesting. Yes, humans love to speculate. In an AI-driven world, we're probably going to do more of it, but it's the instant speed of capital formation that is the signal in all of this. So we think of how the capital formation markets work, VC and all of this stuff. This is showing where it's going.
I completely agree with you. I think it's so easy to dismiss it because there are so many examples of either egregious behavior or just silliness. But, there's market signals in that. And, there's noise and there's signal, and, you have to look through it. And in part, this is like Shumterian, like creative destruction, in real time, steroids, fed by money printing, but it's creating the solution. The money printing is actually creating its solution. It's just not doing it in a way that, looked like, one we've seen before, and because there's new ways of doing it. And so I think that's why there is a signal here. And it's easy to dismiss it and just say, well, we're just going to be focused on like, how you can put real estate records on chain. 100% agree. That's actually what Paxos is focused on. But I always tell people, you can't dismiss crypto as just being like, pets.com, on like, times 1,000. There's also a lot of truth in this as well. And you have to like, understand where that's the case. And that truth isn't just that there's a chain. Like that's very easy and like fashionable to say, I just think blockchain is the interesting thing. No, if you think blockchain is interesting, you also have to think crypto is interesting. And how interesting in exact which ways, that's a big debate, which I think is very valuable to have. But you can't dismiss crypto and just say blockchain. You're completely missing the entire understanding of what's happening.
Yeah, because it's a coordination layer with behavioral incentives. It's ultra powerful, which is why it's the fastest adoption of any technology the world had ever seen until AI came along. Because of this, and it happened at a retail level, and it got made a lot of retail people a lot of money out of all of this. So it's incredibly empowering. So, final question for you is: what's coming up in the next 6 months, 12 months for Paxos? What are you excited about?
Well, look, I'll tell you what we're seeing, and it's unbelievably exciting. Because the Trump administration has come in, there's just been a sea change where people can say this isn't just about a price-driven operating cycle. And that's historically how crypto has operated. Price goes up, everyone gets involved. Price goes down, everyone runs for the hills, right? And you kind of like, that's why you have these like huge swings up and down. And that is changing because I think the average token is down. I don't know what it is now. Maybe as a month or two ago, it's 50% or something. Prices are down a lot. Normally prices are down that much. Like, you kind of lose the enthusiasm, the interest, or, you just have a retrenchment. But it's been quite the opposite, because you can have a fundamentally driven operating cycle right now, which to me is the best environment for Paxos, because it's not driven just by price. We're not here to just to monetize price. I mean, we do in some ways, but that's really not our business. We're not running a retail exchange, so we're not trying to monetize price. We're trying to monetize fundamental adoption. And if you look at the number of financial institutions that are coming in, we just saw Fiserv and MasterCard announce something this week. I can tell you from what we're seeing, all of the largest financial institutions are going to launch crypto and stablecoin applications this year. If maybe it'll be the end of the year, it'll be early next year, but they're all coming. And they're not stopping because the price has gone down. And if anything, they're trying to think, how can we go faster? Everyone else is doing it. They understand there's a 4-year period here of regulatory clarity and certainty and consistency. It could be more, but it's at least 4 years or 3.5 now. And they can't miss it. And so I think the next 6 to 12 months is going to be the most exciting time for Paxos, but it's also going to be the most exciting time for seeing how this fundamentally changes society. Because you're going to go from just this early adopter world. And man, when I was in it at the beginning, I mean, it was really early adopter. It was like, 20 people and like weird. And it's weird now, but it's just like a completely niche thing. Now you're going to be talking about everybody using it and hopefully nobody even knowing. Because that's when you really like hit the point of changing society and you've reached the potential that, we saw all those years ago together.
Look, Chad, amazing as ever. Thank you for being, people don't know, but you've taken everybody on the journey. You've been my go-to person on a lot of this journey from when we first set up Real Vision all the way through to now. And it's just amazing to see what you're doing and how your thesis is playing out. And you've squarely planted the flag in the right place, and the world is coming to you now, and it's going to be really exciting for you guys. So I'm really excited for what you guys get done in the next few years.
Well, it's been awesome being on this journey with you. It's hard to imagine how long ago we started it together, all the way back pre-financial crisis, but you're looking great. I hope I'm looking as good as you.
You are, my friend. Anyway, great to see you, and hopefully we'll meet up soon. As ever, fantastic conversation with Chad. We could have talked for hours about everything. There's so many things happening in this space. It's hard to keep your mind on all of the things that are happening, because this is not just money, and Chad is working on all of that, but there's also the new forms of how capital is raised. We're seeing that in memes. We're seeing how the internet is going to go onto these rails in a number of different ways. And it's really exciting for Chad because he's building out the kind of unsexy part, but it's the side that makes it run for everybody, as every corporation, every bank, every financial institution starts using, and every payment is made over stablecoins, and everything starts to become tokenized. So exciting world, great conversation. I'll see you next time.
Hey, Real Vision viewers, a quick pause to introduce you to today's sponsor, Axelar. Axelar is building the rails for the next wave of global finance, not just crypto, but the future of how assets move, how markets connect, and how institutions plug into open systems. Think of it this way. Bitcoin brought digital gold, Ethereum brought smart contracts, but Axelar is bringing connectivity, the secure link between your favorite blockchain and traditional financial institutions, rushing to plug in. It's why top-tier firms like Dragonfly, Polychain, Coinbase Ventures, and Binance Labs are backing Axelar, and why global giants like Deutsche Bank, MasterCard, Apollo Global, and JP Morgan are already building on it. If you believe the future of finance is open, programmable, and interoperable, Axelar is the gateway. Want to digest deeper? Visit realvision.com/Axelar or follow on X at Axelar. That's AXELAR, the gateway to open finance. Today's video is sponsored by VeChain, the leading layer 1 built for real-world adoption. VeChain launched all the way back in 2015, built for real-world utility before most people had even heard of blockchain. One of the oldest protocols and boasting 100% uptime since launch, it's known for powering real-world solutions and partnerships with global brands like the UFC. Now, they're entering a new, user-focused chapter powered by adoption in the VBetter ecosystem and an ambitious technical roadmap dubbed the VeChain Renaissance. Renaissance builds on VeChain's history of real utility and adoption to deliver a faster, more flexible core protocol, designed to meet the needs of builders and drive mass adoption. The next phase kicks off on July 1st with the launch of Stargate, VeChain's new staking program. It's an evolution that brings VeChain closer to delivering its vision of a world powered by Web3 without compromising on reliability or stability. The future is here, and it's scalable, sustainable, and evolving with purpose. Check the links in the description to find out all you need to know about VeChain Renaissance and the updated staking opportunities available through Stargate.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.